typically what I tell people, Julian, is when you invest in a company, and it could be a REIT or any stock, but you invest in a stock with a 10% yield or higher, double-digit yield, that typically tells you that company could become riskier. The higher it gets above 10, the more risk.
Hi, my name is Julian Castle, and today I have a very special guest. His name is Brad Thomas. Brad Thomas is known as the REIT investor. Brad Thomas, how you doing today?
Doing great, Julian.
Thank you so much for coming on. Brad, we're excited to know about you and about this secret industry called REIT. So could you please give us a little bit of background about you?
Sure. So I've been in real estate for over 3 decades. I've been specifically involved in the REIT sector probably about 15 years. So for about 2 decades, I was a real estate developer, and I guess sold some of my properties to REITs. That's how I became familiar with the asset class.
Mm-hmm.
And then as a result of the Great Recession, 2008, 2009, I began just to start writing about REITs, really educate investors on the asset class. Started writing on Seeking Alpha website, and about 13 years later, now have a pretty large following there, and written a couple books and lectured several universities as well. So I've come a long way in really a short period of time, but I'm always happy to talk about REITs.
That's amazing. And so for the listeners, how big is your audience on REITs?
Well, it's pretty large. I mean, a lot of investors do own REITs, and a lot of retirees specifically. I would say just in terms of the composition of those investors, it really varies. I mean, I mentioned retirees because of that income focus. REITs are forced to pay out dividends to investors. The one law that's important to remember about REITs that was created in 1960 as part of the Cigar Act. Is that REITs must pay out at least 90% of their taxable income in the form of dividends. And that's why the dividend yields are higher than most ordinary stocks or other alternatives. And that's why you see such a large diversified number of investors around the world. So it's a pretty big space. Just finished up a new book called REITs for Dummies. And I'm actually publishing that book in maybe 3 weeks. It'll actually go out to print. And I wrote a whole chapter on global REITs because of the global demand that we're seeing across the REIT sector. And now a large majority of countries now have REIT-like laws. Of course, the U.S. were the first to adopt the REIT laws, but many countries have now followed that. And so it's really exciting to see that the growth of the sector and the number of ways that investors can invest in REITs throughout all types of property sectors or categories.
That's amazing. Yeah, and for the listeners, REITs is a big industry. It's a big asset class. And so a lot of people, you might be hearing this, just now, but it's really been around for a while. And we're gonna get into what are REITs. So Brad, if you wouldn't mind, I know you wrote the book for dummies, giving us a dummy version of the REIT asset class.
Yeah. So, actually, this is my first dummy book, and I'll tell you, it's really exciting. I never dreamed of being a dummy writer. I'm actually going to be working on a second dummy book soon, not REITs, but another sector.
Mm-hmm.
But it's great because I was able to entertain my audience, but also the book is really not just for dummies. I mean, we get into some pretty good technical information. REITs are a unique category, and so it was important for me to explain a lot of the nuances with REITs. For example, within the REIT space, we don't use the typical earnings per share metric, because REITs own real estate. You have to consider things such as depreciation and other items that are on the income statement. So we use another earnings metric called funds from operations. And it's funny because a lot of people will go to like a Yahoo Finance site and they'll look at the PE ratio for a REIT, which is actually wrong. It should be the price to funds from operation, or PFFO ratio. That's just one example.
Mhm.
So, but Julian, what I tried to do was make this book appeal to a broad audience, which would include beginners all the way down to even institutional investors. I think could really get some appreciation for this book. So I basically do everything, including the kitchen sink, at this book, and I'm really excited to have this book. This is my fourth book I've actually written in the past 10 years, but this one's really special, and I'm excited that hopefully a lot of people will read it.
Yeah, yeah, and I know people will. It's exciting. So who is the common investor? Who is the typical investor who invests in a REIT?
Yeah, so I would say, I call that average Joe and average Jane, whoever that is. And it's going to be someone like my mother. I think would be a good example of that,
Hmm.
who really is looking for very safe income. And again, REITs are really income oriented, just like some other asset classes. You've probably heard of BDCs or MLPs, which are also higher yielding income alternative income stocks. But I would say the average person would be probably a retiree or somebody going into retirement at some point, because you're going to be you're not really going to trade REITs. I would not recommend trading REITs. REITs own real estate, and the way to build wealth and true wealth in real estate is through the power of compounding. So essentially what that means in REITs is you're a landlord. These rents are actually the revenue generators that will in turn power the dividends. And of course, you want to see growing dividends just like you want to see with an ordinary stock. So I would say for that reason, you're looking at someone who's either in retirement or close to retirement. But you can start building your retirement, as a millennial, and just compound those dividends over time. And that's a very important part of that business proposition for REITs.
Got it. So it sounds like if the person who's interested is a retiree or someone who's going to retire, it really means that when they buy this REIT, they don't have anything to do, right?
That's correct. Yeah, we like to call it avoid the three T's, and the three T's stand for toilets, trash, and taxes. And so, when I was a landlord and I owned duplexes and some commercial properties, obviously there was a lot of landlord responsibilities or headaches, frankly. You've got to, collect the money from the rent. There are certain provisions that the landlords may be responsible for: the roof, the structure, the parking lot, the snow removal, you name it. And of course, lease up is really hard. You've got to have somebody always trying to lease the property, and when they vacate, clean it up. So there's a lot of responsibilities go into management. The other part of it is just capitalization. As a real estate investor in the past, in the private world, and I still do invest privately as well. But when you invest privately, you obviously have to go to the bank and get your own financing, line up your own equity. So of course, when you invest in a REIT, all of that's taken care of you. One of the most overlooked attributes for REITs is management, because you're actually, when you buy a REIT, you're actually paying the salary of the CEO, and all those other people that work for the company. So that management team is working for you, and you don't have to do, really, to your point, you don't have to do anything. You can just sit back and collect your dividends. Now, obviously, if the management team is not doing a good job, you should fire them, which the best way to fire them is to sell your share of stock. I'm actually writing an article on that now. And I think the title of that article is pretty simple. It's going to be like REITs own properties run by people, and I know that's simple. That's exactly what the REIT model is. REITs own property and they're run by the people. And so we also spend a lot of our time researching not only the underlying properties, where they're located, who are the operators of those properties, but also who's running those properties. And there's a lot of information you could obtain to determine whether you've got a good, a manager of risk or not. A lot of that is, does the manager have a lot of inside ownership? Does the management team deploy capital accretively? So there's a lot of things we can look at for the management team to see if they're doing, a good job. So we not only want to measure, again, the properties, but also the people that run the properties.
Mm-hmm. Got it. So people that are buying REITs, they're not having to, do the trash, the taxes, and the tenants. And so that is a very attractive value proposition.
Absolutely. And again, that's what we call sleep well at night investing. That's part of that value proposition, is just collecting that dividend income. Now, of course, the other component is you've got to buy this at the right price. It's hard to sleep well at night if you buy an overpriced company. So again, you have to look at, and we cover this thoroughly in the Dummies book. We got to look hard at the valuation of those companies to make sure we're not buying something at an expensive price. You wouldn't want to go to the car dealership and overpay, or you wouldn't go to the any store or buy any merchandise or anything where you're overpaying. So we take a really granular look at the value of these companies, because we want to have the highest quality real estate run by the highest quality people, but we also like bargains, and we want to be able to buy those stocks, those REITs, when they're on sale. And by the way, Julian, right now is a terrific time. There's a lot of sales in the REIT space. So I'm very busy. Our team's very busy looking at a lot of great opportunities right now. Obviously, what's caused this is the fact we're in this extended rising rate environment, which apparently is going to continue, even further, perhaps through the end of the year. But we believe that in the first quarter of 2024, we're going to see a stabilization or a pause, potentially a permanent pause in interest rate hikes, which are going to serve as a extremely good catalyst that supports many of these buy targets that we have here at iREIT. And of course, that's what's going to generate the additional alpha beyond the dividend to a substantial total return opportunity.
Got it. Yeah, that sounds like it's really a great time. And I have a question regarding, so what you do is you do the research on these REITs and you inform people about them, right? And so you help these potential investors make a decision on what REIT to choose.
That's correct. And again, we actually put together a model portfolio in the book, just showing the diversification that we recommend. Unlike Warren Buffett, who really only owns about 5 big stocks, he has a larger portfolio, but the bulk of his portfolio is made up of, say, 5 individual stocks. We like to recommend a more diversified portfolio. Again, most people are going to retire if they're not retired now, and so you want to make sure you've got a diversified income, because there are always going to be outliers, always going to be companies that have problems. And so we want to limit those, but we also, the best way to mitigate that risk, of course, is through diversifying not only at a REIT level, but also at a geographic level and a property sector level. Now, today we've got around a dozen different property categories or property sectors. So you can go to apartments, and you can own manufactured housing, and you can own data centers, and you can own cell towers, and you can own net lease properties, which is like a bunch of fast food restaurants. You can own self-storage, you can own cannabis, even casinos. So there are a number of different property categories or sectors, and we cover all of those in the book, from the big sectors to the small sectors. But that way an investor can really decide or determine what amount of risk or capital do they want to put into those specific sectors, and really balance that portfolio based on their own risk tolerances. There are certain property sectors that are going to generate more growth. Those are typically tied to technology. We call them the tech trifecta, which simply means, think of it like a stool. You've got cell towers, you've got data centers, and you've got warehouses or logistics, and they're all tied to that technology. When you order something from your phone, you're going to place the call through your cell phone. You're buying cell tower REITs. Then you move over to the data centers. That's where the information is then taken from that cell tower into the data center, and that transaction, whether it's on Amazon or whatever the e-commerce platform, and then it's going to relay that information to the warehouse logistics, which is going to ship the property or the good to your home. So all of those 3 things, you think about EVs, artificial intelligence, huge catalyst for the data center space. I mean, think about it like this, Julian. If data centers didn't exist, there would be no AI. That's where the AI is actually housed. And think about all the hype people talking about all the AI. Well, guess what? I mean, we own a lot of data centers via a couple of those public data centers that we research and cover.
Oh, that's amazing. So someone who is buying these REITs and this trifecta is definitely taking an investment. He's making an investment in the future, right? Of AI, in the future of, Amazon, for example, and even as we get connectivity in our cell phones improving, they're also taking a part of that, right?
Exactly. I mean, you and I could go buy some houses and duplexes, and a lot of people can do that. I'm sure you talk about it a lot, but the average person, average Joe or Jane, how do you go buy a data center? Well, you buy it through a REIT. That's a perfect vehicle to own shares in these data centers or cell towers, because they would not be otherwise accessible to an average investor. So I think that's a really critical part of that. I mean, cell towers are really beaten down right now, and there's some terrific opportunities there. It seems like every day I have to debate the conversation of satellites taking over cell towers. We'll save that for another day. Love to get on your podcast, get your show again. But again, I think cell towers are going to be around a while. I personally just bought some property and I leased it myself to a cell tower company. Mm-hmm. And by the way, I just signed another deal, another lease with another company, actually a REIT, to put a billboard on the property. But if you don't want to lease to a billboard like I have, you can also go buy billboard REITs. So there's almost any type of property, real estate property sector that you can imagine has already been offered through a REIT structure. And so there's just a tremendous amount of opportunity. Also, again, global. You can invest in a number even of U.S. REITs that invest outside of the U.S. So you can get geographic exposure outside of the 50 states. So there's a lot of ways to play this. And again, I think it's a really exciting time to be in this space. One other point I want to make, Julian, there are, when you look at the real estate landscape in the U.S., the commercial real estate landscape in the U.S., REITs own about 10% of the properties in the U.S. So when you drive home from work today and you look out the door and you see the warehouses and the fast foods and the drugstores and the shopping centers and the malls, all this stuff, REITs own about 10% of that stuff. So what that means is 90% of that stuff is not owned by REITs, which means it's highly fragmented. So you're going to get REITs have the opportunity set to continue to scale and grow beyond the current $2 trillion size of the U.S. REIT market to be substantially larger. So there's a big runway for growth, which is always important when you're investing in a company.
That's amazing. Let's talk about the returns. What, from a different risk perspective, let's say low risk, mid risk, high risk, what can a person who's looking to invest in a REIT expect to make depending on the risk tolerance?
Yeah, well, it's a broad spectrum. I mean, one thing we haven't touched on here is commercial mortgage REITs or mortgage REITs in general. Now, the main difference between a mortgage REIT and an equity REIT, it sounds pretty simple because it is. Mortgage REITs are like, they own mortgages. They don't own the brick and mortar. They're essentially like banks, and except they have this REIT law, this REIT structure. So you have the mortgage REITs. Now, mortgage REITs, you can divide up into two other categories, whether it be residential mortgages, like home mortgages, or commercial mortgages. Those mortgage REITs have a much higher yield associated with them, but they're much higher risk. Typically, what I tell people, Julian, is when you invest in a company, and it could be a REIT or any stock, but you invest in a stock with a 10% yield or higher, double-digit yield, that typically tells you that company could become riskier. The higher it gets above 10, the more risk. What it also signals to you is that there's very little growth oriented for the company. You're not going to see them grow that dividend when they're yielding 10, 11, 12, 13%. So a lot of investors, they love the yield. We see a lot of what we call yield chasers, and we write on a couple of those companies that have higher yield. But I always remind people they're more speculative. They are higher risk. So you're not going to necessarily get a better return. We like the sweet spot. We like those companies that are not yielding like 3%, because that's a pretty boring yield, especially in today's environment, high yield environment. But we like for those companies that are yielding 5, 6, even 7%, that have the opportunity set to continue to grow by 5, 6, or 7% per year. And that presents a better, to us, a kind of the ultimate risk-adjusted return for an investor is kind of that sweet spot. So again, dividend yield is not necessarily the one metric we look for, but a lot of investors who are looking for income, they look at that dividend yield first. But I also like to always point out, you have to look at the safety of that dividend. We look at payout ratios, and that is, what is the earnings of that company and their dividend. If they're paying out more in dividend than their earnings, we call that a sucker yield. And that simply means the payout ratio is over 100%. So if the company pays out, $1 per share in earnings, and they're paying out a dividend of $1.25 per share, that means the payout ratio is 125%, which means the company is essentially robbing from Peter to pay Paul. They're having to take money from some of their capital source to pay their dividend. And we definitely try to steer people away from those types of sucker yield REITs.
Yeah. Okay. Okay. Got it. So yeah, got an understanding. It could be as high as 10, 11, 12, 13. That's more speculative. But then it could also be, 5, 6, 7%. And that's what you recommend. And one of the questions is, for the person that's investing in a REIT, it's kind of like a stock too, right? So you invest at $5 a share, but that share also can go up, right? Besides the yield.
Yeah, for sure. So that's the great thing about REITs, because you do get that price appreciation. Really, there's two things that make up, stock investing. One is that dividend, if the company pays a dividend, and the second thing is the price appreciation. That's how you make money in the stock market. Most of the companies we recommend, I would say the large majority of those companies we recommend, not only REITs, but just in the whole income world, are companies that have dividends. So that dividend is one. You want to see that dividend growing. We like to see those long-term dividend growth records. That's what we call dividend aristocrats. Any company that has increased their dividend for 25 years in a row is defined as a dividend aristocrat. We have another category called dividend kings. There aren't as many of these, but these are the companies that have increased dividends for 50 years in a row. These are companies like Procter & Gamble, Coca-Cola, good examples of dividend kings. So dividend growth is really important. Again, yield is important. You don't want to have a sucker yield, but you won't want to have something that's too low, something in the middle. You want to be able to grow that dividend. But you're right, you also want to have that price appreciation. And the only way to get really good price appreciation is buy the company with a margin of safety. And that is what Benjamin Graham wrote about in his book, The Intelligent Investor, is buying a company below its intrinsic value. You want to get bargains if you can. And frankly, once again, there are a lot of bargains in the REIT sector today. So it's really a good time to really start backing up the truck, or certainly looking at investing in real estate investment trusts.
Sounds amazing. So I like that we went into and talked about how the customers of the REITs, whoever is going to buy, would look into this. What about if someone is a real estate investor that is looking to create their own REIT?
Yeah, so
That's something.
That's a great point. And it's we've consulted with a couple of companies that are considering that right now. Again, you've got to have all those same ingredients. There are certain regulations, they're all in my book, that you have to qualify to be a REIT. Again, you have to pay out. I mentioned that the one primary one, you have to pay out 90% of taxable income. You also have to have 75% of your investments in real estate or rental income. And so, you can't, in other words, if you just had a brokerage company, you own some real estate, that wouldn't really qualify as a REIT, because you have to have at least 75% of your income coming in to qualify. But if you pass these hurdles, then yeah, there's a lot of opportunity, and there's a number of new REITs that have listed over the last year or so. Now, since this year has been pretty slow, thanks in large part to the rising rate environment. But we had a skilled nursing REIT we picked up coverage on recently, and there are a few others as well. So we've got about 150 companies overall that we cover. There's about over 200 REITs which consist of the mortgage REITs too in the U.S. And again, there's about 850 around the world. So it's really growing. And again, it's thanks in large part to that consolidation opportunity, or I should say fragmentation, where again, most of these properties in the U.S. don't have REITs. So I think this is a business model that's going to really continue to grow over time.
Yeah, yeah, that sounds great. So someone that is looking to have a REIT, is it a vehicle for wealth? Like 90% of the payouts are paid out to the person who buys the REIT, right? What about the person who's managing the REIT? Do they have a chance to be a billionaire? Do they have a chance?
Well, this is a great point, and I'll tell you, what you don't want to do is have the management team, become wealthy to your benefit. So
Yeah.
the great thing about public REITs as opposed to privates, there's a number of private. I won't mention any names, but you probably know of some of the private companies that are basically they're either private REITs or these crowdfunding companies, but they're basically making money for their management team. They're getting these huge fees every time somebody is an acquisition's made. They get an acquisition fee, they get this fee, they get that fee, and all of a sudden these guys are sitting on 20-30 million dollar yachts, and they're you're getting a little measly dividend. So the great thing about public REITs is the transparency that exists by owning a public company, because you get a lot better reporting with a public company via the securities SEC, Securities and Exchange Commission. The other thing you get with a public REIT and a public company is you get financial reporting, you get quarterly reporting. So you can see how much that CEO, CFO, or CIO is getting paid every quarter. You can see, if they're investing back into the company, if they're selling shares. So there's a lot more transparency in the public REIT space. And that's one of the primary attributes. I mentioned dividend, I mentioned diversification, but that other attribute is transparency. And you certainly get a lot of that transparency with owning public REITs.
Yeah, yeah. So everybody knows what you're doing with the money, and that's very transparent. That's cool. Is building a REIT for you something that's in the future?
Yes.
And for when can we look forward to having that come a reality?
Oh man, sooner than later.
Love it, love
Now,
it.
I will say this. I know I have to be guarded with that one, but I can tell you this. I did dedicate a whole chapter in my book to ETFs, and
Mhm.
everybody's familiar with an ETF. As I tell my wife, she asked me what an ETF is because I've been talking about it for years, and we're getting ready to list our first. And so that's a basket of stocks. Is what I told her. It's owning a basket of stocks, and it's a portfolio that's going to be passively managed. We've created some really powerful research that backs our passive strategy, which evolves around selecting the highest quality companies with the best value. And so we'll be launching this ETF soon. I'm really excited about that, and that'll be another way for investors to own REITs. And again, I found really over the years that we've got several thousand subscribers from around the world, but there are a lot of subscribers and really investors who really don't have the time or the money or really the expertise to, even though they may read my dummies book, or they may be a subscriber to my newsletter, which is great. We call those DIY investors, do it yourself. But there are a lot of those people who don't really fit in that box, and they would prefer just to have somebody pick that ETF. So that's exactly what I've done. Is I've created this ETF to make it really easy for average Joe and average Jane to expose their portfolio to the highest quality real estate in the world, which is essentially what this ETF is all about. It's diversified, it has high quality companies, with a spin or a lean on value, and that's really important. So we're going to be launching that this year, and that's something I can talk about. We do have the index now live, and we're moving down the tracks now pretty fast.
That's exciting. I'm excited for you to launch that. And you're bringing together the best of the best companies that you researched into one basket, and then making it so that other people can invest in that basket, which you purposely manage and make sure that the companies in there are getting the return that you're looking for, and for the investors as well.
Sure. Yeah, that's correct. Except the one thing we are going to do, we want to keep fees down. So it'll be a passive index, and I can get this to market faster too. Again, I think there's a little time sensitivity here, because I tell people, actually, nobody likes rising rates and the continued rate environment we're in. But the good news is, for the ETF, it's given us time to get the ETF index, to get it filed, so we can actually sell the product on the New York Stock Exchange. And but it will be a passive ETF strategy, not an active strategy. And we're doing that primarily because we want to keep the fees low. Again, I think that's really, really important. And I think the way we built this index, it should be able to really produce some really good results for us. And I'm really excited to get this product to market. It's been something, Julian, I've been working on for a number of years, and it's really exciting to get this product to market here.
That's amazing. So I want to get a little bit of origin on, let's mention your company, Wide Moat Research, right? You have over 1 million subscribers that read your newsletter every day, or every week. And what was the purpose for this? What did you see? What was your vision?
Yeah, so we're a company that is Wide Moat Research, and we have 1 million free subscribers. So you can just log on to Wide Moat Research. We send out daily news. It's free. We like giving out free content, and we put a lot of thought into that content.
Mm-hmm.
We have a couple different products. We have our basic products called Intelligent Income Investor, and that is just a very basic monthly newsletter where we come out with not only REIT ideas, but our best income ideas. And then we have other services off the back of that. You can upgrade into 3 of our other, we call back-end services. So that's kind of the primary business that we have. And it's going extremely well. I'm really excited. We've got a team of about 7 other analysts that work with us to help us provide research across all of those different categories. Of course, I'm the real estate, guru, if you will. And so that's really been my day-to-day focus.
That's amazing. It's really exciting to see how something could be built off of building an audience. And you must have had a lot of love for writing and, helping people see. Is that something that you had before, you got into real estate?
Yeah, actually, I never really thought about, when I got out of college, I always wanted to get into real estate and really learn how to build value. And I went down a little different path. It wasn't traditional. I started out as a leasing agent, and then I found out that I made pretty good money doing leasing, but I wanted to own the properties. The guys collecting the rent checks were the ones that were really making the money. So I started, developing my own properties, and that grew and grew and kind of snowballed into a pretty big portfolio. And then when I got into the publishing business, I just really never really thought about it. I wrote an article on the Seeking Alpha website, and 13 years later, I've written about 1 article every day for 13 years. I mean, it's almost like I'm addicted to writing, but I do enjoy it. I mean, you have to enjoy it, and always like teaching people about investing and really helping. Some of my best articles, I think, are the ones where I talk about my mistakes, and we call them the lessons learned articles, because I want to help investors, avoid some of the pitfalls that I've experienced over my, really 30 years of investing. And so, it's fun. I enjoy doing it, and I'll probably keep doing it for as long as I can. It's the REITs have come a long way, and I think kind of to be able to carry that torch is really special. There's a good friend of mine who passed away a couple years ago. His name was Ralph Block, and Ralph was a mentor to a lot of people, me included. And when he passed away, I felt kind of the urge to carry that for him and for the for REIT investors. And the last book I wrote, I actually dedicated to Mr. Block. And then more recently, Mr. Sam Zell passed away, and I decided to dedicate And by the way, he wrote a testimonial for the book I just mentioned. But he passed away a couple months ago, and I decided to dedicate the Dummies book to Mr. Zell. Of course, he was a multi-billionaire, very exposed to the REIT sector. He's created 3 different REITs and was the CEO of 2. And so, but there are a lot of wealthy people in the real estate business, not only REIT space. Real estate is definitely an asset class, and I know this is your show and this is what you do, but it's definitely a terrific investment vehicle, whether it's the public side or the private side. And by the way, there are some great advantages for owning real estate on the private side. I just wrote an article about that recently, just describing some of the really good advantages of owning private real estate. Things like 1031 exchanges, for example, is a great vehicle to build wealth, among other things. So cost segregation, bonus depreciation. There's just a lot of things that investors can do to really create wealth in real estate, whether it's public or private.
Yeah, it sounds exciting, and I really appreciate you making a tribute to your friend and Mr. Zell. All real estate investors really look up to Zell as being the grandfather or the king of real estate. So it is really exciting that you're putting in and carrying down the torch and also helping other investors know about this space. And so if we want to find you, Brad, where can we find you?
Well, I'm on Twitter. I've recently been showing up there. So that's at @RBradThomas. And then, of course, LinkedIn's my name, Brad Thomas. And then my website, like you said, Wide Moat Research is my main research site. And I would recommend going in there. Just drop us an email and you'll get our daily. We call it Intelligent Income Daily. And anyway, that's the best place to reach me. And hopefully back on this show again soon.
Yeah, for sure. Brad, thank you so much. We really appreciate you and your knowledge. And thank you for coming. We'll see you soon.
Sounds good. Thanks, Joey.